For most Canadian drivers, car insurance is a costly black box. You pay thousands of dollars a year, auto-renew the contract without reading it, and hope you never have to use it. But operating in the dark carries a dual financial risk. If you hit a patch of ice tomorrow, you might find out you are dangerously underinsured for a catastrophic accident. Or you might discover you've been paying for optional coverage you don't even need. To stop the financial drain, we have to deconstruct the standard Canadian auto policy into its three core layers: mandatory, optional, and price. Breaking down these components reveals how much of your premium is dictated by provincial law and how much of it is actually within your power to change. We start at the foundation: third-party liability. This is the legally mandatory baseline across the country. If you cause a crash that damages someone else's property or injures them, this is the pool of money that covers the damages. The legal minimum in most provinces is just $200,000, but lawsuits from serious accidents regularly scale up to $1 or $2 million. Carrying at least $1 million is standard practice, as the legal minimum often fails to cover a major claim. But exactly who you buy this baseline coverage from is a uniquely Canadian quirk. It depends entirely on your postal code. Looking at this map of Canada, you see a sharp divide. In British Columbia, Saskatchewan, and Manitoba, the government runs a monopoly on basic coverage. Everywhere else, you navigate a private market where different companies compete for your business. The rules of the road also fracture by region. In no-fault systems like Ontario and Quebec, your own insurer pays your medical bills, regardless of who caused the crash. In tort systems like Alberta or the Maritimes, you generally have to sue the at-fault driver's insurer for compensation. Because your basic legal protection is dictated by geography, you must understand your specific provincial system to know what actually happens if you crash. Above the mandatory baseline sits the secondary layer: optional physical damage upgrades. This splits into two main choices: collision, which fixes your car if you hit something, and comprehensive, which covers theft, vandalism, and extreme weather. While the law considers these coverages optional, the banks do not. If you are leasing your vehicle or paying off a car loan, your lender requires you to carry both to protect their investment. Once your vehicle's value drops below $5,000, collision premiums often equal the potential total loss payout. To control costs, increase your deductible. Raising this barrier from $500 to $1,000 directly lowers your annual premium. Physical damage coverage is essentially a math equation. It only makes sense when the replacement value of the vehicle is significantly higher than the annual premium. The final layer of the policy is the pricing algorithm. This calculator processes your mandatory and optional choices to generate your final price tag. The algorithm starts with rigid data. It targets your exact age, your gender in most provinces, and your postal code. Geographic density heavily influences your base rate. In densely packed urban centers like Toronto and Brampton, the algorithm assigns a higher risk profile. But you can influence the algorithm through the car you choose. Some vehicles are statistically more likely to be stolen or expensive to repair, and insurers adjust your quote based on those theft and safety ratings. The algorithm also tracks your personal history. Speeding tickets and at-fault collisions create a compounding penalty that stays on your record for several years. While your baseline price is anchored by rigid demographics, the specific car you drive and your habits behind the wheel determine your final cost. To lower that final price, you have to break the habit of auto-renewing. Rates vary significantly between companies, so checking quotes from multiple brokers every year is the most direct way to find a lower rate. You also need to confirm that every eligible discount is applied. Insurers rarely apply lower rates for winter tires, alumni status, or home and auto bundling unless you explicitly provide that information. For young drivers, the algorithm is particularly expensive. A total lack of driving history translates to the highest possible starting premiums. Usage-based insurance allows safe drivers to bypass some demographic penalties. By sharing real-time driving data with the insurer through an app, you can prove your actual risk level and qualify for lower premium rates. Young drivers can also build a clean history earlier by being listed as an occasional driver on a parent's policy, which is often significantly cheaper than a standalone policy. Loyalty to a single insurance company rarely results in the lowest price. Maintaining a low rate requires you to actively force the algorithm to recalculate your risk every single year. All of this optimization is tested the moment metal hits metal. The steps you take at an accident scene determine whether your policy actually provides the protection you paid for. Never admit fault at the scene. An on-scene statement can complicate the claims process later. Fault is a technical determination made by adjusters using specific provincial rules, not by the drivers involved. You must document the evidence immediately. Photograph the positions of all vehicles and exchange policy numbers and driver's license details before anyone leaves the scene. Soloing the crash, you typically have 24 hours to contact your insurer. Depending on the damage amount and whether anyone is injured, you may also be legally required to file a formal police report. Mastering these 3 layers ensures you have the exact protection required by law without paying more than necessary for the risks you actually carry. Knowing how to manage the mandatory layers and the post-accident protocol gives you full control over your coverage.